If you're nearing retirement, you might be wondering, should I change my investments once I retire? And it's a great question because retirement isn't just a new chapter of life. It's a complete shift in how you use your money. And what worked while you were still earning a paycheck may not work when you are living off of your savings. So in today's video, we're going to be talking about why your goals in retirement are totally different, the number one investment risk retirees often overlook, how to structure your money for your income, flexibility, and peace of mind, and what really matters when building a retirement strategy that lasts. So let's get into it. Retirement is not about growing your wealth anymore. So let's start here. When you were working, your investment goal was pretty simple. It was about growing your wealth. You were adding to your accounts, investing for the long haul, and riding out those market bumps. But retirement changes everything. You're no longer building your nest egg. You're actually living off of it now. And that means that your goals shift from growth of income, stability, and preservation. It doesn't mean that you stop investing, though, but it does mean that your approach needs to evolve. Retirement isn't about getting the highest return. It's about building a plan that lets you sleep at night. Now, there's one risk that most retirees aren't prepared for, and that's the sequence of returns risk. And here's what I mean. Imagine two people retire with the exact same portfolio, the exact same average return, the exact same withdrawal rate. But one of them gets good market returns in the earlier years of retirement, and the other gets poor returns right away. Even though they earn the same average return, one ends up with far more money later in life. You're probably asking why. Because when you're withdrawing income, timing really matters here. If the market drops early in retirement and you're pulling money at the same time, it's going to create this double drag. You're selling at a loss and you're going to be missing out on that recovery. And that's a sequence risk. And it's why managing volatility in retirement is more important than chasing those big gains. Now, your portfolio should match your real life spending plan. So if you're not chasing returns, what should you focus on now? Well, think of your retirement money in terms of time and purpose. What money do you need in the next 1 to 2 years, in the next 3 to 5 years, in the next 10 to 20 plus years? Each layer has a different goal here. Now, you might need stability and access in the short term, moderate growth for the midterm, and more longer term assets to keep pace with inflation. Now, I often use the idea of buckets with a lot of my clients, and it's a way to help people visualize how their money is going to be working for them. Now, what matters more than investment type? Well, it's about structure and strategy. You don't need to overhaul your investments the day that you retire, but you do need to think differently. So here are a few important ideas. Number one, liquidity matters now. In retirement, having cash or near cash assets for 12 to 24 months of spending essentially creates this breathing room. You don't want to be forced to sell long-term investments during a downturn. Number two, volatility is now personal. When markets drop during your working years, you may have ignored it completely. But when you're drawing income, every dip feels more real. So design your plan to manage your comfort with risk, not someone else's. Asset location beats asset selection. It's not just what you hold, it's where you hold it. A well-structured mix of accounts, such as your RIF, your TFSA, your non-registered, can all improve tax efficiently dramatically, even if underlying investments stay very similar. And retirement is a marathon, it's not a finish line. And many Canadians will spend 25 to 30 years in retirement. So yes, you still need growth, but you need it with control and context. So let's go through a real life example here. Let me introduce you to Angela. Angela retired last year at 63. She had $900,000 in total savings. It was split between her RSP, TFSAs, and non-registered account. Before retirement, she had about 80% in equities, and it worked really well for her working years. But once her paycheck finally stopped, the market dip started feeling different. Every drop made her wonder, can I still take my income from my investments? Should I stop spending altogether? She wasn't sleeping very well. She was second guessing every withdrawal and every dollar spent. So, what we did is we restructured her plan, not with different products, but with different purpose. What we did is we created a 2-year buffer of spending needs in low volatility assets. We also created a mid range segment for those 3 to 5 years for those goals within that period of time. We also created a long term bucket for her growth, and that was for her future so that it could also keep up with inflation. So now she sees every dollar that's coming in and when. She spends confidently again. And it's not just magic, it's just about creating structure. So, what not to do when you retire? So, let me give you 3 quick cautions. Okay. First, don't make big changes out of fear. It's very common to want to go to cash when you retire, but this can backfire. You need some growth to fight inflation for the next 25 years. Next, don't assume what worked before is going to work now. You've changed. Your goals have changed. Your income needs have changed as well. Your strategy should really reflect that. Don't copy your neighbor's plan. Everyone's retirement looks different. Different pensions, different taxes, different health needs. So build a plan around your real life. Now, here are 5 key questions to ask yourself about your retirement investments. First, can I clearly explain how I'm going to generate income from my savings? Do I have a buffer for market downturns, or will I have to be forced to sell? Am I confident in my risk level or just guessing? Am I paying attention to taxes across my accounts? And do my investments align with my actual retirement goals? Now, if you're unsure about any of these, that's okay. This is what thoughtful retirement planning is all about. Now, a quick note here on do-it-yourself versus delegating. And this is just one last thought. You don't have to do it all yourself. Some Canadians really enjoy managing their own investments, while others want to spend their retirement on grandkids, gardening, not in a spreadsheet. And there's no really right answer or wrong answer here, but retirement is one place where a clear plan and thoughtful structure makes all the difference, no matter who's managing the accounts. Changing your investments in retirement isn't about chasing returns. It's about building a system that supports your life, your goals, your lifestyle, and your peace of mind. If you want help building a structure that makes sense for your retirement, that's exactly what I help Canadians do every single day. You can learn more at stonecitywealth.com. I'm Adam. Thanks for being here today, and I'll see you in the next video.